with times like this where we transition from, say, slowdowns to potential recessions, I just want to give people an opportunity to take a quick look. And this is somewhat based off of a book that I had read by Jim Cramer. And I know that that might turn some people off, but I think that with this, it adds a little bit of value and context. So especially if you are going to be looking at trading stocks in something like the stock market and you're actually looking at actively managing your portfolio, you need to look at specifically the ebbs and flows of specific sectors, because during certain financial times, whether that's recessions, downturns, just growth periods, or times where the market is peaking, different stocks will act very differently. And if that's the case and you're actively managing your portfolio, it might be something that you need to take a look into to understand specifically at what point certain companies might overperform and some point which ones might not. And the answer to think about while you're looking at this is like, well, I don't really want to take care of and measure what the macroeconomic environment is doing. Then that's perfectly fine. And I get that. And I know it takes a little bit of time to do so. But what you can do is just invest in the SPY, which make things a lot easier for yourself. And so let's just take an opportunity to look at this cool little graphic here, which I think is very helpful in kind of understanding. And I know it's a little bit difficult to kind of immediately get your eyes into, but this is basically certain sectors of the S&P 500 and how they perform over the investment cycle. And so up here, you can talk about the peak, the slowdown, the recessionary or the trough period up until their expansion. Then it kind of repeats the cycle of peak, recessionary, and yada, yada, yada. And so what this basically does now is looking into the recessionary times, which is what we're kind of coming up onto. It might be prevalent as to why certain companies like real estate, industrials, financials, all these companies are starting to take a little bit of a dive. And as you would expect during most recessions, most sectors will take some sort of impact. And so this is real data measured since 1960. And so this is, not just made up data or speculation. This is legit data that's been looked after the last 7 periods of what we would call recessions. And during these recessionary periods, real estate, technology, industrials, financials, those are the ones that are kind of leading the pack in terms of being impacted the most. The ones that are actually doing rather okay are healthcare, utilities, consumer staples, which are staying rather flat during these sorts of periods. And once you kind of get to the bottoming out period of this, real estate continues to roar back, technology comes back, consumer discretionary, people are starting to spend on normal items again that might not necessarily be needed. Purses, clothes, some stuff like that would be considered discretionary, maybe candy. Whereas staples, things like deodorants and normal sort of everyday items, trash bags, stuff like that, are now kind of lulling when it comes to this because, while people might be buying slightly more of it, everyone kind of uses this on a day-to-day basis. And so people aren't going to be rushing back to the extent of, say, real estate, technology. It's not as cyclical per se. Utilities are kind of there with that. And energy also up about 27% during these recovery periods. And that's probably because more growth is happening in the economy. And with that, you'll obviously have some more folks leading and businesses growing. So with that, you'll have to fuel it a little bit. During the expansion periods, you have real estate continue to do well, technology continue to do well, financials continue to do well. So everyone, generally speaking, does rather good. And the thing I'm also noticing here is these things are, generally speaking, returning 10 to 20% a year. You have some outliers, but it's pretty cool to see that during these 3 periods, most of these sectors are returning anywhere between 10 to 20% per year. And then when things start to slow down is really, the peak or the recessionary periods is really where you're starting to see things go down into the single digits of growth or even negative growth. So that's kind of cool to kind of look at in that perspective. But looking at the slowdown or the peaks, and then there's a few other things I want to talk about as we get more and more people to join us here on the live. We have Real estate, which is kind of peaking out 2% growth, but financials, generally speaking, leads. Consumer staples leading, healthcare leading at the peaks. And so then you end up back in to this recessionary time period. So I posted this on my Twitter feed. So those of you guys that do follow Twitter, and then I wrote specifically just a quick note about this. So let's just read this. As business cycles move between recessionary to expansion, the average returns for specific sectors varies greatly, as alluded to by the picture that we just looked after. If you are an individual investor who's looking to actively manage your portfolio and outperform the S&P 500 throughout the cycles, you would need to know this by heart. Recessions favor healthcare, utilities, consumer staples. I said stables, I meant staples. The laggards are real estate, technology. Expansion favors real estate, consumer discretionary, materials, energy. The sectors lagging are utilities and consumer staples. Expansion favors technology, financials, real estate. Sectors that lag are utilities, consumer staples, and healthcare. During slowdown, sectors that are favored are financials, healthcare, consumer staples. Sectors that lag are technology, consumer discretionary, materials. And my curiosity is have you guys seen something like this before? And do you think that looking at this now, if you're specifically technology focused or utilities focused or however focused your portfolio is, does this maybe make you rethink, as some of you guys may recognize we are heading towards some sort of recession, right? Or some of you guys just think we're heading towards an economic slowdown. But irregardless of whether or not you think it's recession, slowdown, does this make you think about how your portfolio is structured as of the current? Or are you going to view this as an opportunity to say, shore up some cash in the short term, waiting for, say, technology stocks to bottom out before you start to invest back in to the market?